How are you now? Broadcasting from the VFS studios at Milson's Point in Sydney. You are listening to the all-new BIP Show, Season 5, Episode 7. Don't forget to hit subscribe and rate us wherever you get your podcasts. And a reminder that all financial information in this podcast is general in nature only. Speak to a professional advisor about your needs. Speaking of which, I am James Whelan, Investment Manager at VFS Group. Paul Colgan is still stuck in Davos. He's waiting for his luggage to arrive, I believe. This episode is being recorded in Milson's Point on the 19th of August. It is about 10 o'clock in the morning. Now, as part, sort of changing it up a little bit, so the guest will be joining us later on from Brookside Energy. We're going to talk about energy and oil markets, which is great. Not a sponsor of the show. An open and honest conversation with the managing director of Brookside about exactly what's going on in the energy space over in Oklahoma and actually how bad labour shortages are there and how bad the shale space, or how good the shale space actually is. So stay tuned for that. For now, I thought that I'd just give a bit of a market overview. And for that, I've been joined by a good friend of mine here and also our Director of Strategy at VFS Group, Jack Kouzi. Jack, how are you now?
I'm good. It's an honour to be on. I've been waiting for this.
You've been knocking on the door for years.
I think I've been waiting for this spot for 2.5 years. Yeah. I mean, I am very honoured. No, but thanks for having me on. And hello to everybody out there. Hope you're safe, doing well.
Yeah, mate, it's been a hilarious couple of weeks on the markets. We may have commenced what is the next leg up of what will be an even more hated rally than the last one.
Yeah.
Or are we sitting in the bear market rally and everyone thinks that more downside is ahead of us after a 20% bounce? We've got
massive.
What are your thoughts locally on that?
I mean, I said to you this morning, I think it looks a little bit tired after the big rally that we've had. But who knows? I mean, like you said, there's a lot of cash on the sidelines.
Yep.
Waiting to get some type of return. Even though with interest rates, sorry about that noise, guys.
Yeah.
In the midst of construction here. Even with interest rates rising, yields and returns are still the name of the game, and we could see a push up. I still expect a nice little decent rally into Christmas, but we could return to some bumpiness over in the next couple of months.
Yeah, I think that probably a couple of extra percent in cash would not be such a bad idea. The fact that we've had an amazing July, and that rally was significant. Nasdaq was up about 12%.
Yep.
That was an amazing July. Historically, we have weak August. I do apologise for that noise, guys. We're going to get through it as best we can. Don't worry about it. I'll try and my voice will drown out the sound of drilling from upstairs. But it's good for at least the construction industry is showing it's got some support here in Australia, which is great. Traditionally, August and September are a little bit off in midterm years for the S&P 500, and then September, October, and November are always really, really bullish in midterm years. So coming off the back of such a strong July, I would not be surprised to see maybe things start to return to their means.
When are the midterms exactly?
November. It's the same.
November.
They run the same sort of election cycle. So the 2 years.
It's going to be a cracker of a midterm, I'll tell you that.
He's going to get demolished. I think the Democrats will get absolutely demolished.
I mean, I was listening to Liz Cheney. I know she's a Republican, but she got absolutely smashed by a
she's lost a
Trump candidate.
Now, I'm looking at the fund manager survey here as well, just as fresh on my mind. So this is from Bank of America. They're seeing that there is a little bit more cash has been deployed into the market. They were currently sitting up around that 6% level. Usually 5% or over is a bullish signal for them, a contrary bullish signal showing that they've sort of reached that maximum fear area and there's enough cash that can go into the market. So it's good to see that cash has actually come down from that 6% level into about a high fives level, I believe it's there. I didn't actually write that down before sitting down. What they say in the survey is that sentiment is still bearish, but not apocalyptically so. I managed to get that first time, apocalyptically. The bull and bear indicator is showing it's max bearish, so fundies see no immediate reversal of the bear rally. And this is the key quote. We remain patient bears. Would fade SPX over 43.28 as rates up and profits down is our base case. The US dollar is still seen as the most crowded trade. And we're looking at the usual overweights that you would see in this sort of market. No surprises here. The biggest overweight position for fund managers is cash. Healthcare follows in second, and then it's daylight, and then commodities in third too. I've speculated and did speculate that if you wanted to take the contrary trade and go against the US dollar, if you think that maybe the Fed expectations are done, overcooked, or at least cooked to a level that you are happy to start consuming it, and that other countries have to start raising their rates, especially if Europe is maybe moving into a rate rising cycle as they are. And don't forget the DXY is 60% against the euro. So maybe if you want to take a contrary position, going short the US dollar may not be for everyone, but if you want to go long commodities, that may be the best way of benefiting from a weaker US dollar. And don't forget, so commodities do well and emerging markets do well in a weakening US dollar situation as well.
Yeah.
So there's two trades that could be on there. I'm not in any way suggesting going long emerging markets at this particular point. But I think that the other big one, the other big kicker that's here is that value, for the first time, the net percentage of people who think that value will outperform growth. Jack, what have we got here in front of us?
I can't see that here, but I saw that when you sent it around to me.
The first time since August 2020.
Good old growth, they're back.
The growth is now seen as being the performing, as outperforming.
I mean, if you've got long-term trends over the last 15 years, it's always been growth. It's good to see. As a growth investor myself, who's been, been hitting the walls in the last couple of months and the last year, it's good to see everybody's going back to growth. I think it's got to be the right areas of growth also.
Yeah.
I think, companies with, no cash or high price to sales multiples, I still think they're not going to be in vogue. But your quality companies, your quality growth companies, I still love big tech. You know that. I think it's a place to be.
Yeah. If we look through the top five, and anyone who wants to do a cheat sheet, if you want to keep it simple, have a look at a quality ETF. So QHAL is one that we have on the books here. So I know it quite well, so I can talk of that. But that's a good quality ETF. Yeah. Have a look at the top holdings in that company. You've got Apple, you've got Microsoft, Nvidia, United Health, Johnson & Johnson, those sorts of names. That's quality big names.
Yeah.
The tech that's in there is quality tech. Yeah. Do not get distracted by Bed Bath & Beyond or the meme stocking. Again, you will get rug pulled on this one. Now, I mentioned emerging markets, Jack. You're the China expert. What's the latest on the China?
A couple of big news pieces out of China in the last week. So a few things. On Friday, we saw 5 companies looking to delist from US exchanges. Yeah. What's interesting to note is 5 of those companies were state-owned enterprises. And I think this actually opens the door for a possible avoidance of some of these big stocks in US, like Barber being delisted off US exchanges. So just an interesting point for everybody out there. There are 273 Chinese companies listed in the US.
Right.
7 of them are state-owned enterprises.
I did not know that.
Yeah. So the Chinese have always maintained that they've got no problems with their tech firms, like Barber, like Lufax, and others being subjected to new auditing reports that the US want.
Yeah.
But they've always maintained that state-owned enterprises have sensitive national information, and they don't obviously want to comply with those audit reports. So these 5 looking for delisting, there's only 2 more.
So that's 7. That 7 included the 5.
Yeah, the 7 included the 5. So we could see, maybe this delisting threat that's happening at the moment start to abate. So I thought that was an interesting point coming out.
Okay.
The other one that came out of China is a couple of days ago, their largest firm, Tencent, reported.
Yeah.
It was their first revenue decline in the quarter ever. And
what was incremental?
I've got the
why?
figures in Well, they've been hit hard by tech regulations. You've also got, a Chinese economy that's going into COVID lockdowns and out of COVID lockdowns and into COVID lockdowns, and that's hurting the consumer.
Yeah.
Gaming revenue was down, which is about a third of their revenue in total. Yep. Because of the new laws limiting gaming, and they've also been limited from acquiring new licenses on games within China. So I thought that was a big piece of information. They did guide up.
Okay.
They thought the outlook was getting better.
Yep.
They felt in the conference, they said, we don't think there's any more overarching big tech regulation that's going to happen that's going to affect us. So that was a big piece of news that came out. And the other piece of news that came out from Tencent was there was a rumor they were going to divest their $24 billion stake in a company called Meituan, which is their big food delivery company. And this is part of this whole overarching tech regulation with China where regulators there don't want guys like Tencent and Barber owning pretty much a majority stake in a lot of their companies.
Okay.
We're talking about the bigger tech companies there. So Tencent divested from JD.com, which is their second largest e-commerce player, late last year. So, I thought that was a pretty big, interesting piece of news that continues to go on in China, and they're trying to limit this market concentration of their tech companies. Now, their belief is that this will benefit innovation in the long term.
Yeah.
But they were the three big pieces of news, and that sent Meituan, which is their fourth largest tech company, massive company for those who haven't heard of it. Do food delivery, ride sharing. They also integrate on the merchant side, right? Kind of like a Square, but without the payment sector.
Got it.
And they were down 9%. So I think the big one to take out is these SLEs delisting.
Yeah.
So it's one to watch.
Are they just switching straight off from NYSE?
Yeah, so they'll make their primary listings. A lot of them are already dual listed,
yeah,
right? So it's not a massive issue, but they'll delist, make their primary listing either in Hong Kong or a local exchange, maybe the Star Market within China. But you're actually seeing a wave of that. So just to say that 2 days later, a company called Lufax said they're going to make their primary listing in Hong Kong.
Yeah.
So
I still quietly know we exited that position for my clients a while ago, but I do like the Hong Kong exchange as a buy. And I exited this thing so long ago, I can't even remember what the stock code is. 1313.
Yeah,
I think it is.
Yeah. Well, there's a new wave of IPOs coming through Hong Kong, and a lot of Chinese companies still want to list.
Yeah.
And previously they wanted to list in the US to access US funds. That's not necessarily something they need to have anymore. I mean, there's plenty of money floating around Asia. And there's plenty of, northbound and southbound connecting to Hong Kong, which is, a glut of funds. So they can raise that money if they want to.
All right, good. Well, I think that the US market has shown enough stability to be able to hold off. I'd be a buyer of any big dips if you can find them. And the China, where are you putting it in China?
I still believe in Chinese tech. I know it's gone through a very tough period. I mean, something like 10 cents off 60% off its high. So if you've been invested in it, and I have, it's been a very rough period for the last 18 to 24 months. I still believe when you look at Chinese tech and you compare their revenue and their multiples to US tech, they look cheap. You just got to ride it out. And I think the last 18 to 24 months have been very tough, but I'm a firm believer that we're at the end of regulation within China.
I believe so.
And this should start to see some growth for some of these companies. I'll highlight one more and I'll stop there. Their second largest gaming player, NetEase, reported last night, and they beat on all three of the top lines. So, there are pockets of signs of life there. I still like something like the KWeb.
Yeah, the KWeb is the ETF listed over in the States.
US, which will give you
tech. Yeah, the one that I prefer is CNEW.
And the great thing about the KWeb, I'll say, is most of their holdings are listed in Hong Kong. So if you do get this wave of delistings, it will affect the short-term volatility of the price. There's no doubt about it, but then they don't have to deal with a delisting issue of taking those shares and transferring them over. So that's the one I favor out of all of them. And of course, this is not advice. This is just their information.
General advice. If you don't understand,
general advice only.
General advice only.
Be careful. Can be very risky investing in China, as it's shown in the last 2 years.
I was extraordinarily blunt last week, which is if you don't understand what general advice is, maybe you should just switch off the podcast now.
Well, that's it off.
Okay, but there you go. If anyone does want any more information about this or anything more, feel free to reach out to me or to Jack as well. He's got a pretty significant online presence on. I believe you're big on the Instagram.
I am on the gram and the YouTube, and I wouldn't say it's big, but we try our best.
It's getting a bit bigger, and just amazingly that it looks like the noise has stopped upstairs for morning tea. So thanks, boys, for all your help upstairs. Good on you, work. Jack. Thank you very much for joining us.
Thanks for having me on. It's a pleasure, and hope everybody's great out there.
Good. Cheers. All right, now we're going to keep on going with the podcast, and as part of the reshaping of the show, first and foremost, too, it's currently 9:41 a.m. on the 19th of August, 2020. Just sort of moving through bits and pieces. I do apologise for a significant amount of building noise that's coming through here. So my voice will be trying to drown out the building noise that's there in the background. There's nothing I can do. I do want to get a show. I wanted to get a show out today. So there you go. As part of the reshaping of the show, speaking of which, I'm arranging to have not only more fund managers on, but also to talk directly to more companies. And here's one that, full disclosure, I hold myself, the company that I hold. My clients do hold this company, and it's Brookside Energy. I wanted to have a conversation about oil and gas. Want to have a conversation about energy. Occasionally, I like to reach out to the MD of this company and talk about oil and gas and energy and generally what's going on in the world. Very important feature in the commodity space at the moment, especially with everything that's going on. And I will just get a little finger on the pulse of what's going on. Now, Brookside Energy, a little shale play drilling in the Anadarko Basin, which is the heavyweight of, the oil and gas industry, whatever it is you want to say. I'm sure that David will be able to help us out. I'm fortunate enough to be able to know the managing director of this company, David Prentice. More than 25 years experience in the commercial management and business development within the natural resources sector. He's a pretty funny guy, and he's also extraordinarily smart in the space. Today, joining us from Oklahoma, David. I believe it's Oklahoma. David, how are you now?
G'day, James. Yes, joining you from sunny Tulsa. 85 degrees outside here in the evening, and a beautiful day here today.
Oh, sensational. I think that our weather patterns are sort of matching from this side to that side as we get into the shoulder season. So we've got a little bit of warmth coming through here. Now, we might want to get into the climate situation, how the world is getting a little bit hotter, and maybe sort of how... No, we won't. Skip that. Don't worry about it. So we've got too much to talk about later. Now, we want to make it real quick and sort of get into it as much as we can. Keep in mind too, folks, that Brookside are not a sponsor of the show. This is simply me with an investment manager hat on, being able to talk to someone who runs an oil and gas producer. So it's pretty good. It does mean that, no punches can be pulled on this one. And as an advisor on this stock and someone who owns it as well, David, I'm going to skip the usual question of what do you do and how do you make money, because we already sort of know that. But mate, the share price first and foremost, what's going on there?
Yeah, look, there's a disconnect between what we've achieved, over the last 12 months in terms of, the success that we've achieved in drilling our first 3 wells, and a massive disconnect between, the cash flows and the fundamentals of what we've achieved and where the stock price is currently trading. I think that's, a function of flows in the market rather than necessarily sort of investor sentiment. I think, the small cap sector in Australia, particularly, James, you'll know more about this than I do, but, the money flows in and out of particular sectors, if you like, and we've seen our share price kind of underperform, I think, because the volumes have slipped away in terms of, how much we trade on a daily basis. And so that's frustrating, and we need to work harder to close that gap. And I think with such a large retail shareholder base, I need to do more work, and I guess us as a company and management team need to do more work moving forward, trying to bring our retail shareholders along with us on the journey and explaining and educating them in terms of, what we do, where the value is and what the future looks like. And so, we've got some work to do there, and I guess looking forward to getting cracking on that. So that would be my take on the share price.
Okay, that's good. I don't like to harp on about share prices because it's often that if you have a good company that's making money, that has that has cash in the bank, that should really speak for itself. And related to the share price, I mean, it could be higher, but let's not harp on that because some things you just can't change. That's unfortunate. So now let's go big picture, having a look at this first. Everyone is talking about how underinvested the oil and gas market is at the moment. Can you give us something on the ground of exactly how bad, or is that overdone, or how good, or what's the actual smell over in that part of the world, which is now so important to being able to provide for a pretty underfunded and pretty overburdened energy market?
Yeah, look, it's very, very clear that the last 10 years at least of underinvestment in the space, and particularly in that, in the E part of the E&P business, so the exploration part of the business is really what's really shining through now. And so, I read somewhere today that, we're really in that part of the cycle where companies are really showing that capital discipline. And so we're really looking at, harvesting essentially known reserves and not investing the capital that needs to be invested to discover new reserves. So, that's, why I'm so bullish on the sector is that, outside of the, what the demand picture looks like going forward, the supply side is where I think the pinch point's coming. And you've got, politically around the globe, you've got, a big push from the politicians for the large producers and even more recently, looking at, at the Saudis, this sort of kind of pressure to essentially increase production and help to lower prices. And it's just not happening. People are either unable to increase production, or they're reluctant to do that because, they're conserving capital and showing that discipline and returning capital to shareholders. So, in my view, that's going to have the effect of keeping supply tight and prices higher for longer. So that's the theme that we're certainly seeing here in on the ground in Oklahoma and around the world generally.
Yeah. Now, do you think that politically the tide has turned, at least for a temporary? I mean, we've seen what's happened in Europe, and we've seen that their dependence on one country's gas has led to a pretty critical situation over there. Do you think that politically it's going to be less on the nose to be supportive of oil producers or of actually powering industry via alternate sources, not depending on just one or two things?
No, I think that's right. I think, people are going to, you get through another Northern Hemisphere winter and there's going to be a big scramble on here, I think, for the Europeans to try and work out what they do to, with Russia and how that's all going to play out. And people have worked out that, that our industry does fulfill a vital role in terms of, providing that energy security. And so, I think the tide is starting to turn there, and we as an industry could do more in terms of educating people about, the things we're doing to be more efficient and have less impact on the environment, and all of those things combined together, I think will help to shift sentiment around the sector generally.
Yeah, now the fracking has been a dirty word for such a long time. No punches pulled here. But do you think it's like the fracking industry is maybe a little bit misunderstood in Australia?
Oh, for sure. Look, I was just having a look today at at the history of fracking, if you like, and interestingly enough, the first commercial application of hydraulic stimulation, which is the kind of the polite way of describing fracking, it was actually done in March of 1949 in a town called Duncan in Oklahoma, which, as it happens, is about 20 miles west of our range as well. So, there's more than 70 years of the successful application and the improvement of the techniques that's been going on here in the US for that period of time without any issues in terms of environmental impact, and it's really been a cornerstone of how we're able to produce these wells and get such good productivity out of them. So, we don't, as an industry, we don't see it at all as a dirty word. It's part and parcel of what we do, and has been for almost 100 years. So, again, it's an education process, something we need to talk about more openly, and just make people aware of the benefits and how we manage the risks.
I think also myself, sort of talking as someone who's done a lot of work in the ESG space, that having a huge dependence, being able to just blackball things like that has actually been integral to, or instrumental to, why we're at the situation that we're in now, and with such an energy shortage, and also with this crisis that's going on in Europe, and also, warnings of a crisis being here because of gas shortages, which is weird that would be a situation. Asking Queensland residents to have their lights off after certain hours, it seems ridiculous that that's the situation that we're in. I think that right now we can't be. I don't want to get on my soapbox about it because people hate it when I do that, but I don't think that right now we can be too picky or choosy about where we get our stuff from for now, as we move into sort of the next bit. Now, David, I noticed on your LinkedIn that you'd shared a pretty cool little article here from Richard Spears, who's VP of Spears and Associates, and I had not been following them as closely as I should be, and I'm probably going to remedy that going forward. It was just talking about that there has been a big backlash, especially in the the Biden administration, hanging it on some energy producers for returning cash to shareholders and paying off debt, as opposed to going into more drilling and going into more exploration. Now, I noticed that you had shared that note. Did you want to go into that and just talk about the details with regards to companies that are surveying, companies that are exploring versus companies that are drilling, and where the trend is heading in that direction?
Yeah, so Richard was making the point that his firm tracks activity, particularly in the service sector of the service side of the oil and gas sector. So he looks at frac spread utilisation, drilling, how many drilling rigs are operating, how profitable those various businesses are, and one of the things he was looking at was the geophysical services side of the business, and making the point that is a very good point, is that in the last 12 months and in the 12 months before that, we've seen record low investment in geophysics, which is really at the pointy end of the exploration part of the E&P, side of things. So what that's telling him, and I agree with him, is that people aren't spending on exploration. They're spending on increasing production and then returning the surplus cash flow to shareholders, which only means that they're not replacing the reserves or they're not attempting to replace or doing the work required to replace the reserves that they need to replace. And that for me is if we needed more evidence of of this kind of prices being higher for longer, then that's just another very important signal to me that we're just going to have this tightness in the supply side of the equation for the foreseeable future.
Yeah, and I'll make sure that I post it on the website as well. It's a really good one. I'm going to reach out to Richard as well and see if he wants to have a chat later on in the year. But he does draw the line with the way that he's his barometer is a company called Dawson's. I had it here, Dawson Geophysical, which is the biggest land geophysical service company, and he tracks that for their revenues. And what is it? So Dawson's, when we see Dawson's annual revenues return to over 200 million, currently it's about 30 million. So it's way down. So the less money they make, the better it is for the oil price, theoretically, if you want to make that two-step jump. Yep. So he's saying that when their revenues go back up, it means lots of people are searching for oil. The geophysical, they're surveying land. Yep. And that would be the signal that maybe the oil price should be due to come back. Now, supply, as we know, supply is not always leading to price. We see that we've still got a supply shock, and yet the oil price has not been responding. I mean, I've often had a bit of a joke that if you want to make God laugh, tell him what your forecast on the oil price is, and see how that goes. So look, that's that. So he's very much an oil and gas price bull, based on that really simple way of putting it. I'll put it on the website so you can have a bit of a look. Now, David, it would be remiss of me doing anything close to my job if I didn't let you talk about the update for your company. You had a recent release, your quarterly, I believe. There's lots of cash in the bank. I don't want to forecast or lead that, but anything that you'd, any big notes or points going into the last part of the year?
Yeah, look, I think that probably good to touch on just what we've achieved in the last 12 months. And people tend to always want to be looking forward. The market always wants to look forward, and we get that. But just in terms of touching on what we've achieved in the last 12 months in bringing these three massive wells online, what that's done to our cash flow, and is all important. And we're obviously very proud of the work that we've done and focusing on that kind of execution part of the business. But really, the implications of that are we've now found ourselves with this massive resource that we can now move forward and develop. This kind of two-pronged approach to that work, which is really about developing the resource, so looking at what is now effectively a proven resource, which we now can just go ahead and drill up, and at the same time looking at ways that we can potentially fast track that through some sort of A&D type activity, and that stuff goes on over here all the time and is very common in the Anadarko Basin. So that two-pronged approach, being alive to those sort of A&D opportunities and also at the same time getting on with their own drilling, is what shareholders can look forward to over the next 12 months. So, we'll see some pretty significant growth in our production profile and also the cash flow, but also be on the lookout for, potential, M&A activity that might come out of that side of the strategy as well. Ultimately, the Brookside story is about, increasing the asset base and capital growth is what's going to reward shareholders. So, focusing on that part of the business, trying to increase the scale and size of the asset base, and then And then in the short term, some really interesting things going on, obviously with results coming out of the last well we drilled, the Flames well, looking really, really good. And then, I think we're going to have some stuff to say about increasing our footprint in the Anadarko Basin. And then lastly, on our Bradbury prospect, which is named after the great Australian speed skater,
our first gold medalist in Winter
that's
Olympics.
It.
Yeah.
Yes,
I saw him speak. He's very, very funny, a very self-aware and very funny guy. I'd recommend if you get a chance to hear Stephen Bradbury speak, please do so. But the Bradbury, I jumped in.
Yeah, no. So we've got some exciting stuff going on around the Bradbury prospect as well. And in fact, I've actually spoken to Stephen, and when he saw that we'd named the prospect after him, he was delighted, and we exchanged emails. And so yeah, there's something there for the shareholders to look out for in the next few weeks or so as well. So lots going on, and really super excited about the next 12 months and what we're going to achieve.
Outstanding. Operational. So Opex is a conversation that's come up a lot on Twitter, and obviously I'm going to represent the people on Twitter as much as they love me and love what I say all the time. Apparently, is there an issue with Opex outweighing revenues? Yeah,
no, absolutely. Look, we have never shied away from that question. I mean, when back in 2017, 2018, when we first started, conceived this plan to pick up this acreage in Swish, we people forget the oil price was sort of $40 or $50 a barrel, and the gas price was sort of $2.50 or thereabouts. So we went into this understanding that these wells would need to generate fantastic rates of return at those prices for us to be able to justify developing the resource or commanding a premium for it when we were getting ready to sell it. So no, we're not concerned about that, and we certainly don't want to get on a treadmill where we're needing to, drill marginal wells to create revenue to fund the next marginal well. That's not our business model, and will never be. So these wells are anything but marginal. They're super productive, and we've seen the Jewel well paid out in 6 months. The Range is on track to pay out in sort of less than 8 months, and so those kind of metrics are going to mean that cash flow is going to stay well ahead of any development schedule.
Okay, well, cheers for that. That's right. I could not let the podcast go. I could not let a conversation go without asking about that, because people seem to make a bit of a fuss about it on Twitter, and that's why you make a market. That's what it does here. David, anything else you'd want to add? Otherwise, I'm going to wrap it up, mate.
No, mate. I've been enjoyed talking to you. I've loved the probing questions, and look forward to doing it again soon. Yeah, mate. No worries at all. Thank you very much. That's the cost of doing business, but it has been really good having you on, talking about the oil and gas industry, and also a little bit about your company too, which is cool. So, cheers for that. Don't forget to subscribe to the show, rate us, and leave a review wherever you get your podcasts. You can find us on iTunes, BIP Show. And we're also on Twitter at the _BIP_ show. Yes, we're on Facebook too for some reason, not sure why. I've got a website. I'm going to put that note from About Dawson's by Richard Spears on the website as well. And also, I might put, David, I'll chuck your quarterly up as well, your investor presentation too, as a special thanks for you to come on, for coming on and telling us what it's like on the ground over in Oklahoma as well. And I hope you go okay. Yourself, and I look forward to when you get back. We'll get a beer in when you get back. Okay. Thanks, James. Sounds great.
No worries. Thanks for joining us, everyone.